Welcome to episode 166 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. How are we going today, fellas?
I'm fantastic, Jace. The AFL season up and about and keeping a lid on it. And I know this episode might come out in a few weeks' time, but Essendon won against Hawthorn. So just keeping a lid on it. I know one thing for sure, we are not going to finish bottom four. 100%. So absolutely pumped. So Nick, you're looking dazed and confused with that statement. You think I've gone too early?
I'm just writing it down. 100% Essendon will not finish bottom four.
100%.
I really hope we're not revisiting episode 166 to talk about this at the end of the season.
Big call, I know.
It's a big call, mate. This early in the season's dangerous, I would say. But anyway, I'm feeling good. I've just noticed I look as tired as hell, but I'm up and about. I actually need new goggles, and I haven't had the time to get down and get new goggles because, as you know, Marty, I do like a swim. So instead of new goggles, I just proceed to make them more and more tight so they don't leak. But what that does is it looks like I'm extremely tired for half the day because of the bags under my eyes from the extra tight goggles. So looking at myself now, I need to just get down there on the weekend and get some new goggles to prevent this stuff. But feeling good. Jace, how are you? Shorter haircut? What's happening? You go a bit shorter?
No, all good. I think I thought I was actually due for a haircut. I thought there was a bit too much lift going on. I'm trying to go to the Marty school of haircuts, to be honest. I'm just trying to bring it across, and we're talking about just I don't know, people want to be like Marty, people want to act like Marty. And speaking of Marty, I did a presentation at the Accounting Business Expo, and we were talking about different things that have happened from the podcast. And Marty, you've been getting some epic feedback and people reaching out to you about episode 161 around homeschooling. Tell us about that.
Yeah, it's been fantastic actually, and surprising. I've had people connect with me that are homeschooling their kids, and one of the comments was it was just nice to hear someone saying they were proud that they were looking after their kids' education in that way. It's not something you commonly hear. Other people have been sending me videos on, a balanced approach, trying to support the journey forward, which was lovely. And other people have been really honing in on the benefits of homeschooling. So it just goes to show you there's different hats for different heads, and it's just keeping an open mindset. But I thought it was great. And please, Jace, do not go down the Marty Vid's school of hair, because your hair is exact and very good. Mine is just organised chaos. So please don't take your fashion tips from me.
Oh, mate. No. All good. If you haven't checked out our YouTube channel, also a very good opportunity to not only mention to go back to EP 161 and check out the homeschooling app, but also do it on YouTube, where you can see Marty's hair in absolute just flying fashion. So check it out. Turning our attention to today's episode, though, Nick, you're driving this one with a fun discussion on all things trade finance.
Driving it, but need a lot of support from you guys, because you guys are actually probably more equipped to talk about this than I am. But I wanted to bring the topic of trade finance in mainly because we're seeing a lot of it in our business. We have an asset and equipment side of our business, assets being, cars, machinery and whatnot. So we're talking with a lot of businesses, a lot of manufacturing businesses, for example. And trade finance keeps coming up, and we've had some really positive outcomes with businesses that, number one, don't know what trade finance is. So number two, they didn't have trade finance. And once you get inside a small business and understand their operations, how their business works, how the cash flow works, you can really add value with different products that are out there on the market. And one of those is trade finance. So I thought it'd be a good opportunity to, number one, explain what it is, and then sort of pass to you guys on how are you seeing businesses use it, really what I think it helps push forward your business growth. So it's a pretty in-depth topic, but if I'm going to summarize it and then try and put it into an example where people will go, yep, that makes sense. Trade finance really frees up liquidity or cash flow in a business for either the buyer or the seller of goods or services in order for them to continue to push their business forward. So, as you would know, Jace, accounts receivable can be a big issue for a lot of businesses. They do work for people. They send those businesses an invoice. Those invoices can be anywhere from, due in 7 days to 120 days. So you've got this gap, and I'm talking about on the service provider side now, where you've supplied the service and the job's been done, or the goods been provided or delivered, or the product. You then send an invoice, and then you hope that they pay that invoice on time. And then given, depending on the size of the business and where your business is coming from, some invoices might have really long payment terms, as I said, 90 or 120 days. So you've got to wait 90 to 120 days, even 60 days for that revenue to come into your business. You then don't have that revenue to grow your business, take on the next job. Let's say that, well, not service, let's say it was a product you provided and you needed to purchase goods to build that product and give it to the person that sold it off you. So you've actually incurred a cost to deliver that good, and now you've got to wait 90 days or 120 days to get that money back. So trade finance is a few different products, and that example that I just talked about, you would use invoice financing. So you can have a third party come in, or a lender come in for to explain what the third party is, and that lender will actually lend against your invoices. So Jace, if you provide me a good, I take that good and you say, here's an invoice due in 90 days. You can take that invoice you've got, which is almost like a guarantee that I'm going to pay if I'm a good customer of yours. You can take that to the bank and you can say, look, I provided this good to Nick. There's a 90-day invoice. The money's coming from Nick in 90 days. Mr. or Mrs. Bank Manager, can you give me that money now so I can then continue to grow and fuel my business? Now, there's a few things that go along with that. Obviously, there's credit assessment. So, the bank's got to have a look at your business. Where's your customers coming from? What are your payment terms usually like? But it's just a quicker way to get your invoices paid instead of waiting for your customers. So that's a really basic example, but it's used heavily in importing and exporting, and it's a different product. It's not invoice financing. It's quite often what you'll see is a letter of credit. So, there's risk mitigation. So if I'm exporting to you, Jace, well, you want the good, but you don't want to pay for the good until it lands. But I've got to build that good, send it offshore, so it's got to go on a ship, and it could take 3 months to get to you. From the seller's point of view, you want that payment so that you can start producing the good that you then got to send to the buyer. So a letter of credit comes in, which again is a third party. So a bank comes in and they guarantee the seller that they will get paid. They will get paid when the good is delivered or when the good is shipped, and then they guarantee that the buyer that they won't be paying for the good until the seller meets certain requirements, such as building it and shipping it. So, yeah, it's hard to explain all the different circumstances because there are so many. But the easiest way for me to summarize it is when you've got money owing, the bank comes in and they pay that money for you, knowing that there's an invoice that's going to be paid by a customer of yours within a certain time period. And it can get rid of so many cash flow issues for businesses, particularly when you're dealing with big clients like government. Like you speak to a lot of manufacturers or businesses that work with government. Government has extended payment terms at times. They always pay, but they can drag out payment times. So it's just getting money in the door quicker instead of waiting for your client to pay. Brilliant product. And those that have it, those businesses that use the product, absolutely love it and use it to the maximum limit that they can, because we all know business is all about growth and cash flow, and we all know how detrimental a customer not paying an invoice or taking a long time to pay an invoice can be to your business cash flow. So, Jace, I wouldn't mind your input. You're obviously an accountant. You deal with a lot of small businesses. What kind of businesses do you see use trade finance? Mm-hmm. Is it many businesses, and can you see from your end the big advantages in cash flow?
Yeah, definitely, mate. And great question. So, the ones that straight away come off the top of mind were kind of already touched on slightly. Manufacturing, big one. So, where you got lots of parts and different things that you got to bolt and put together, there's a time delay on buying all of the supplies that go into making a good and actually getting that good out the door, delivered, installed, and then paid for by a customer. So, there's a huge time delay. And usually, where these things work really, really well is when there's a time difference between starting and finishing, whether you're manufacturing, importing, exporting, producing. Outside of manufacturing, though, the other main one is e-commerce or people buying, importing and exporting goods. So we find a lot of our e-commerce clients are, let's say, clothing retailer or online store. They've got to bring in a bunch of clothing to then be able to print logos on them or get them produced and shipped out the door. So there's a few different steps in the supply chain where it might be a giant shipment coming from overseas, and then in Melbourne, something happens in Melbourne, then it goes off to the customer to then sell. So they're another great example of where trade finance bridges the gap between how long it takes to get the goods from overseas, come over on a ship, get it through customs and out of Port Melbourne into their warehouse, ready to be made and put on the backs of clients all around Australia.
I think goods in anyone who just carries large accounts receivables. I think of one of our clients who actually was a waste management business. So he's actually a client of yours as well. So
that just popped into my head too as you said that.
Yeah. So they had big contracts with developers where they would go around and collect waste from developments, and then take that waste and do what they have to do with it. The problem is you're talking about really big invoices with really long payment terms. So you've got big chunks of money outstanding for a long time, and that's really just providing a service, not even really a good. So we've got a trade finance facility in place for them, and that just helps free their cash flow up. So it's products and services as well.
Those ones we find are super important to our customers from a cash flow working capital point of view, where if you are dealing with a big client that stretches the payment terms, they say, look, we're going to pay you in 30, 60 or 90 days. And you need that customer. Let's say it's a really great relationship, but they've got some power to kind of push back on their payment terms. And you go, well, hang on a minute, we really need that cash in the bank to pay wages, pay for our equipment, keep the wheels turning, buy the new equipment that's going to keep our business growing. So rather than waiting, 30, 60, 90 days in business when you've got, wages and superannuation and bills to pay, rather than having that cash in your bank on the spot for a small cost of the interest, I guess, that you're losing out on rather than waiting for the payment. There's a win in that way, but also, I think that's where, to answer the second part of your question is, do we see it a lot and is it very common? We're not seeing it so much in the smaller business land, kind of sub 2 million turnover. If you're under 2 million turnover, we don't see a lot of businesses in that realm that use trade finance, whether they think it's out of their realm or it's not possible for them. And maybe Marty can throw to you on some of the parameters around when it does become the right size to start looking into trade finance. But we definitely see our over 2 million clients, over 2 million revenue, they more commonly have trade finance facilities or, a range of finance facilities so that they're covered in event of anything happening in their business. So maybe Marty, what are some of the parameters?
Glad you mentioned that, Jace, because that's what you see a lot of. It's like sometimes up to 2 million in turnover. People just haven't seen the product before or have no exposure to the product, but it's so beneficial as a company grows. And particularly you see a lot wanting to have payment in advance for goods overseas because a lot of the times, even though you're paying a fee, like sometimes it can take 1% of the total limit as a startup cost, and it varies depending on the risk of the business. But again, then if you can get a payment in advance offshore, you generally get a discount for those goods coming across as well. And a lot of people don't think about that. So, there's some significant discounts, sometimes 5 to 10% that they can get off purchasing those goods overseas that then get shipped across. So you've got to work out what's right for your business. But it is a fantastic product because a lot of times people under 2 million in turnover go, all right, I'm funding this out of my own cash flows, or I get an overdraft. And an overdraft's really just for the everyday running of the business with revenues coming in, expenses going out. But trade's very specific, almost like best describe it as project management. So again, you're not eating up any other cash flows. Your project management, a shipment across from overseas into your business, and then, obviously selling. So some people like to get terms, like you said, Nick, on a letter of credit, where they might get 120-day payment terms to overseas. And then what, like some businesses do, they get that product shipped. The client overseas knows that they're going to be okay because they've got a letter of credit guaranteeing the payment. And then the business owner in Australia goes and sells that product and pays it in advance. And if they don't, obviously the bank's there got the letter of credit. But the bank needs more security in that situation. They'll look at, who the person is overseas, making sure they're reputable, ensuring the business is strong. But again, you're not genuinely putting up property or any of the business assets other than the goods. And that's a benefit as well, because then you can strategically still do property lending against relevant property lending. And then you have this cash flow aspect, which you could fund independently. So it gives you a lot more flexibility in running your business, doesn't chew up cash flow, and it's relevant to the goods being purchased to then being sold. So it's an integral part of the cycle. And you'll see that as businesses get more sophisticated and have higher turnovers, that they see that as much more useful. At the smaller levels, it's just an unawareness thing, and sometimes they just carry it in general cash flows.
I'm just going to say, I wasn't even thinking about this. I like what you said about not tying up security, because if we think about the people that come to us for business funding, the first thing you look at is, well, how much can you get them as an overdraft without security? And then if you want more of a limit on your overdraft, then we've got to start bringing properties and other things. And I think, well, that then stops them from doing, as you said, investing in property or what it might be. So, and most of the times it's just, as I said at the start, and people are just unaware that this product actually exists. So it just really demonstrates the importance of, if you want to grow your business, whether you're, 2 years in, 5 years in, you need to really understand what products are available and what products are best suited, number one, to my business, but number two, to my overall goal as an individual and what I'm trying to do from a wealth creation point of view. So I'm glad you brought that up. But what I was going to ask you is, well, how does it work? So do you get a percentage of your invoices that are owing? If they're not taking collateral or security, what determines how much you can actually borrow, for lack of a better word, because you are borrowing at the end of the day? And then based on that, what are the costs?
Lenders will generally want some, margin of safety as well. So they'll look at the full, let's say, purchase amount from overseas, and they'll issue like a percentage that they'll fund against that purchase amount. So it might be, for instance, like it can go up to 90%, but anywhere between 70 and 90%. And the pricing is very much on price for risk. So it's always hard to give any form of interest rate, and you try and stay clear about that. But, to set that up, maybe 1% on the total facility, and generally somewhere about 0.75 to 1.25% of whatever the trade is that's happening, the cost on that. So if it's, let's say, got my calculator here, it's a 400 grand trade. I'll go the high end just to give some. So it's about a $5,000 cost, but it could be as low as 0.75, could be as low as $3,000. So the more secure, I guess, the more the lender has confidence in regards to the strength of the people that they're purchasing from and the businesses they're dealing with, it's really priced for risk. So, but if you've got, you'll have to pay the lender 10 to 30% deposit in order to issue the facility, or the actual supplier. You would pay them that deposit, and then the lender would fund the rest. So there's many different ways to skin it on trade. Invoice is really interesting, sort of similar parameters. Invoice finance is much more, it's similar to an overdraft because you're keeping momentum in your cash flow. So you're just getting the payments in advance. And again, they'll look at the balance sheet, making sure that your company's strong. They'll look at the people you're invoicing, but like they love to have like sort of blue chip type of, people, partners that you're dealing with there. So they'll review that and then issue a facility based on that. And they'll look over the last 6 months as to who those suppliers are, whether they're making their payments within a certain time as well. So they'll do a review on that and make sure that, obviously that when they're issuing a facility that it's going to be okay. So, but there's some of the parameters around it.
From what you've told me there, it sounds like the more strength the business has and track record, I guess the business has that the bank can see, possibly the bank will grow with you.
Correct.
They learn that there's no little risk attached, and the business continues to grow and pay when things are due. Then they can kind of grow alongside you.
And there's a couple of things there, Nick, in regards to the lenders. Will want a certain type of size of trade or invoice facility to make it reasonable for them as well. So when Jace says that $2 million mark of turnover for a business before they started thinking these solutions, that's probably what the lender wants as well. However, I would encourage businesses that are growing, anyone that's turning over $1 million and is starting to think about solutions moving forward in their growth, it's a great time to have a discussion and just make yourself aware of the solution. So even if you have a smaller facility to begin with, you can certainly expand with your business growth. So it's about you getting comfortable in utilizing the facility, and it's, of course, the lender getting comfortable with you and then building that strength as a combination partnership. Really key elements for the future in your growth as well.
No, I like that. I was just going to say as well, guys, I remember years ago, must have been 2020, Xero bought a invoice finance company called Waddle, and they bought them for like $30 million. And
I remember that.
Xero wanted to get into the small business finance game. They were and what Waddle did was technology integration into a Xero file. So, prefacing this question, it's about the big banks versus some of the new lenders you guys might be seeing in this space. I was excited at the time, thinking, geez, this is a really great solution for the small business clients that I was just talking about, that Marty, you were touching on, being able to go sync their Xero file into Waddle. Waddle does a scan to go, is this business, by what they can tell from P&L, balance sheet, profitability, can we start to give these guys some money and, give them access to their invoice funds in advance of time before their clients pay them? And it was all technology driven. It was very quick, very easy. The money would appear in the bank account. They would set up a separate bank account in Xero, which would be then where they would collect the money to by a BSB and account number or payment of the invoice. So then they knew they were going to get paid. Clients were getting money in faster. And that was, the product, which is why I could see, I guess, Xero's excitement at the time of buying this product to integrate it into, millions of small business Xero files. And they were going to pop up a little button basically saying, get funding, get finance. And you can imagine, there was also then maybe the reason the product was shelved is that, if you've got a non-sophisticated small business owner that all of a sudden starts clicking get funding, get finance, and, a business that maybe wasn't ready to take on debt without the checks and parameters that having, brokers like yourselves involved in a decision like this. That's now been shelved or sold off. Xero went, no, we're going to stick to our core, which is accounting software. And that was bought back by CommBank. So CommBank wanted to increase its, its technology and how it was going to be able to offer finance and invoice solutions. So what have you guys seen now? I mean, are there some up and comers and players in the market that are doing great things with technology, or is it the big banks really dominating the space?
I'll let Marty comment on that, but Marty, before you do, I just want to say one thing, because something you said there really resonated with me, and a concern that I've got about this space is with the introduction of digital lending, there are a lot of these funders that have come to the surface. And it's really easy for businesses now to get money and to get money quick. The problem is that if you don't have advice behind that product, what we find is people just get into this trap where they get the wrong funding, then they need more funding to cover that funding because it's too expensive, and they just go down a hole that they can't climb out of. So I think what really worries me at the moment is, you're in the car, for example, on a mainstream radio station, and then you will hear an advertisement for some of these online business lenders. Now, they do have a place because they do solve a lot of problems for us as well when with some of our clients, but we're generally using them as a short-term solution, and then there's a medium or longer-term solution to get the client out of that product. So all of these products that are popping up, I really worry that people go direct to those providers online because it seems simple and easy. Because the thing is, the providers online do not care about your business. They do not care about what your long or short-term plans are. All they want to do is get you that facility and charge you as much as they can. So we would much prefer people come to an advisor, whether it's us or anyone, and get advice on the range of products that are out there, because we've often seen people take those online products that are quite expensive. They're quick, but they're quite expensive. But there could have been better longer-term facilities, such as trade finance, that could have also fixed the problem.
I'll second that as well, to say, for clients of future and for anyone out there who's got an accountant, talk to them first before you go and do these online business loans. You think that, maybe you're burying your head in the sand and think that it'll create a solution, and it does short-term, but then when the repayments start coming out and they're bigger and higher interest than ever, the pain starts again. So talk to your advisors first, talk to your accountant, talk to your brokers. They're there to have you back in these situations. Don't act alone. Even if you think the deal is good and it's going to help you, sometimes these deals are too good to be true. And we've definitely seen some high interest loans crush businesses into liquidation or into shutting down because they can't afford it.
There's usually a midway point. You think about that, like you're talking about those online invoice payment providers. Usually there's a huge margin of safety in the way they operate. So they'll only approve certain amounts of invoices. It might be specific invoices, which might only be 30% of the overall invoicing. And what you've got to check out is if, like you're talking about, whether there's a higher cost involved. I mean, they're looking at heavy transactions, so maybe it's not so much a high cost, but you need to find that out as well and get that advice up front. Sometimes the banks can go the direct opposite way, like they'll have property backing it, they'll over-securitize the facility. It'll really be challenging to set it up and take 6 to 8 weeks to set the whole thing up, look at profitability, look at everything else. But once you've got a facility set, it's there, for the long term and usually well priced as well. But like we talked about before, you don't want to be tying up security that you could be building wealth with property elsewhere, utilising that security. So you need to find that mid-range point. And there's a lot of providers now that are providing that mid-range point. So instead of getting the money, let's say, in 2 days, 3 days, it might take 3 weeks because they have to look at your balance sheet. They have to, analyse the business, your business, the other business that you're dealing with. However, again, once it's set up and they're satisfied, you're going to have a facility for life that's going to be beneficial, and you're probably looking at that mid-range price point. And that mid-range price point is actually very lucrative because you've freed up all the property security and you've got something that functionally is actually going to work for you to be able to get payments in advance across, get discounts off the supplier, and really keep your business motoring as well. So that's why, to get the advice, I probably know of about 3 to 4 in that mid-range point that are doing it really well. And it's just a matter of, dropping us a line and we'll go more specific in your needs. It is really specific to each company that we deal with, because again, it's priced for risk. Depends where you're at, how healthy your business is, how healthy your suppliers are, and the whole proposition. So I don't want to give specific rates, only because they can vary depending on that risk in what we're dealing with. Make sense?
It does, Marty. It does. It makes perfect sense. And
one more thing. Sorry to cut you off.
No, please.
Just the unintended consequences of not understanding these types of facilities. A lot of people sometimes will take out a business loan over 5 or 6 years in order to get product from overseas, then bring it back out and then sell it. But the danger sometimes is that the business loan is 5 or 6 years. So they go, instead of paying back the loan, I'll just keep it there, put it back into the natural cash flows of the business, and then create hardcore debt that they're not paying down that's relevant to what they're doing. And that becomes a real pain point. So again, the right facility for the right function in your business is critical. So I've seen that happen a lot of times. So yeah, go on, sir.
No, that's perfect and a great summary. I was just going to say, look, that final call to action, that if this is something you're like, geez, never heard of it, or my mate's business uses this, but I didn't think it was right for me, this is the perfect opportunity to have a conversation with the team at Innovate. So get in touch with Nick or Marty, or direct through the Innovate website, inovayt.com.au. Epic team of people there that always help, always ready to help. I know they do an epic job for Future Advisories clients and the Numbers Game listeners. So if you haven't checked it out, go and do that. And who knows, trade finance, invoice financing, and a bunch of other finance solutions may be what you need to get your business to its next stage of growth. And until next time,
keep trading. Game over.